Hare Krishna. Once again, welcome to my channel, Purposeful Prosperity. As you know that we are trying to extract the wisdom from the different chapters of Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market return. So today we are trying to go through a very small chapter, chapter 6, where it has been explained that dividend are the investor's best friend, in fact. And most mutual funds confiscate too much of these dividends. So let's just try to understand what Bogle is trying to say here in this chapter. So mutual fund managers give dividend income a low priority. So few of the points which Bogle mentioned in this chapter is that dividend yields are vital part of long-term return generated by the markets. Second thing is that compounding over the long term, dividend made a contribution to the stock's market appreciation that is almost beyond belief. And for that, he is given a chart from 1926 to 2016, close to 90 years of data. And you can see that when the S&P 500 only price appreciation is happening, you are able to make only 1.7 million. But when the dividends were reinvested, we were getting 59.1 million. So that's a huge amount. So you can see that dividend, when reinvested, it can create a huge wealth. So mutual fund manager contracts consistently calls advisory fees, which is based on the fund's net asset. It's not on the dividend income. That's something we have to really understand because they know that dividend income comes and goes. Sometimes it's high and low. So in order to get the maximum benefit for themselves, they always put the fees on the fund's net asset and not on the dividend income. So the fund expenses, so whatever dividend income that your mutual fund get, that is normally consumed. A huge share of that is consumed from the total dividend income earned by the funds by your fund expenses. So it's the fund expenses which takes away most of your dividend income instead of getting reinvested that into the market. And if you take an example of Nifty 50 total return index and Nifty 50, you can see that there is a dividend yield of between 1.5 to 2%. And with this 1.5 or 2% over a very long term, it can create a huge difference between the returns retail investor is going to get. So he's trying to give some data for year 2016 for the US market, and where he's saying that the staggering portion of the equity fund dividend income is consumed by the expenses. So he's saying that for actively managed growth funds, they are going to consume your 100% of uh, dividend income. And if you look at the actively managed value funds, you can see that they are consuming 58% of your dividend income. In compared to this, if you take the low cost index fund, the growth funds consume just 4% and the value fund consume even less, which is just 2%. Because growth funds have uh, high gross yields compared to the growth funds. So value funds have high yields. That's why the consumption is also low. So with this data from the Morning Star clearly suggests that an intelligent investor should go for a low cost index fund if he really want to see the compounding of his price along with the dividend. Then at the end of the chapter, Bogle is trying to refer quotes from a blogger of dividendgrowthinvestor.com, where the blogger has put couple of points. So in the first point, he said that I really like Bogle's message of keeping cost low, keeping turnover low, staying the course, and keeping it simple. Then further, the blogger is saying that Bogle is against the widespread practice today of building portfolio consisting of 10 to 15 asset classes, uh, whose whole purpose is to create complexity and to generate fees for greedy asset managers. That's something very important. Nowadays, if you see, there have been many funds which have been recently launched, which is consisting of many different asset classes. And they are trying to say that by combining all these, we can create a better wealth for the investor. But the intelligent investor really need to understand that all these funds were created just to get some extra fees from the retail investor like us, and it's the asset manager which are going to become wealthy with that, not the retail investor who are investing the amount in them. And the third and last point, the blogger is saying that keeping it simple means owning the stock market and some bonds. It also means that not getting too fancy or too carried away by adding fashionable asset classes. We clearly know that how cryptocurrency asset classes people have become fashionable, and looking at the wealth it has created in the past, many of the real investors entered into that market and then they suddenly lost all their money. So with this, we have to understand that we should really like to keep investing very simple, because investing is all about common sense. The more simple we take just by having the stocks and the bonds, we are going to create a better wealth, above average return for a retail investor. So Bogle's quote in this I would like to mention is that the successful investing is owning businesses and reaping the rewards provided by the dividend as well as the earning growth of our nation, and for that matter, the world corporations. So definitely our full growth will come with the earning growth plus your dividend. So if those dividend income is getting consumed by the mutual funds, then definitely your growth will be lower. And I would say I think this Boggles learning was implemented in Feb 2018 uh, by the SEBI, where in one of his notice, the mutual fund benchmarking is now following the total return index. If you look at the point two, where it says that at present, most of the mutual funds are benchmarked to the price return variant of the index called PRI, and which only captures the capital gain of the index constituent. On the other hand, the TRI takes account into dividend and the interest payout that was generated from the basket of constituents that makes the index in addition to capital gain. So with this change, starting with 1st Feb 18 onwards, all mutual funds need to compare their fund performance with the benchmark TRI instead of the PRI benchmark. And that is the reason, if you see from last couple of years, suddenly you see that we came to know that most of the large cap funds are not beating their benchmark. So you have to question it and ask that how what happens that from last 15 20 years they were always beating, but now they are not able to beat. That's because they were benchmarking against a wrong benchmark. And that's the reason they can clearly show that they are beating the market and they are beating their corresponding benchmark with a margin. But once the TRI feature has been implemented by SEBI in order to protect the retail investor, definitely now they are finding it really hard. And more, it's going to become hard, not just for the large cap, even the mid, the small cap are also going to similar kind of a heat. Once you start comparing not just their corresponding benchmark, but in the previous chapter, we have seen that we have to also compare them with the benchmark TRI of index growth and the index value, depending on the fund style they have. And that's the better comparison, and that's where we can see that the indexing always wins. So that's all from this chapter. Once again, thank you for staying with me. I think if you really like this kind of content and you think that this is going to add some value to you, feel free to like, share, and subscribe to my channel Purposeful Prosperity. And we'll meet again soon with the summary of the next chapter. Thank you. Hare Krishna.